The notification appears at 2:17 a.m. A salary credited just hours ago is already gone. Rent is due in 3 days. 3 different loan apps are sending reminders. A credit card payment has been auto-debited, triggering an overdraft fee. On paper, nothing catastrophic has happened. No market crash, no job loss, no disaster. And yet, the system is collapsing quietly, invisibly, inside a single bank account. This is the modern financial paradox. How can someone earn, spend, and still feel perpetually behind? How does money, something designed to provide stability, become a constant source of anxiety? The answer is not found in a single bad decision. It lies in a system, a structure of income, behavior, incentives, and hidden mechanics that quietly shapes outcomes over time. This is not a story about poverty or excess. It is the story of financial friction, how small, invisible forces compound into overwhelming problems, and more importantly, how those forces can be reversed, because financial problems are rarely sudden. They are engineered over time, and that means they can be dismantled the same way. At its core, money was designed to solve a simple problem: inefficiency in exchange. Early economies struggled with barter. Currency emerged as a universal intermediary. It promised simplicity. You earn, you store, you spend. Over time, the system evolved. Banks introduced credit to solve another limitation: timing. You no longer needed to wait to earn before you spent. You could borrow against your future. Credit cards, loans, and EMIs transformed consumption into something immediate. The promise was compelling: smooth out life's financial bumps. Buy now, pay later, invest in yourself, build assets. And for a time, it worked. A salary became not just income, but leverage. A person earning Rs. $30,000 could access Rs. 3 lakh in credit. The system multiplied financial capacity. It created a sense of expansion. But underneath this promise lies a subtle shift. Money stopped being a resource you control and became a system that controls your future decisions. To understand this, imagine your finances as a simple pipeline. Income flows in from one end. Expenses flow out the other. In a stable system, the inflow is greater than the outflow. The excess accumulates as savings, which then becomes investment, which generates future income. A self-reinforcing loop. But introduce credit into this pipeline, and the structure changes. Now, part of your future income is already allocated to past spending. Your pipeline no longer starts empty each month. It starts with obligations. And this is where the system begins to destabilize. The spread of easy credit didn't just change how people spend, it changed how they think. Financial decisions shifted from, can I afford this, to can I manage the monthly payment? This is a critical transformation, because affordability is about total cost. Monthly payment is about perception. Our $50,000 purchase feels large, but our $2,083 per month over 24 months feels manageable. The number shrinks. The decision becomes easier. This is not accidental. Financial institutions design products around behavioral psychology. Minimum payments, zero-cost EMIs, limited time offers, all engineered to reduce immediate friction. But the cost doesn't disappear. It gets delayed, fragmented, and hidden. This creates the central paradox. The tools designed to provide financial flexibility often become the primary source of financial pressure. Now layer in inflation, the gradual increase in prices over time. Your income grows slowly, if at all, but your expenses creep upward continuously. Add lifestyle inflation, the tendency to upgrade spending as income increases. A better phone, a better apartment, more subscriptions. Then add financial leakage, small, recurring expenses that go unnoticed, but accumulate significantly. Food delivery, app subscriptions, impulse purchases. Individually, these are minor. Collectively, they are structural. And here lies the hidden flaw. The modern financial system assumes discipline from individuals, while systematically encouraging the opposite. The result is a slow accumulation of imbalance. No single decision causes the crisis. It is the aggregation. Then comes the catalyst. It is rarely dramatic. It might be a medical bill, a delayed salary, a job switch, even something as simple as a festival season. With higher spending, this is when the system reveals its fragility. Because once your financial pipeline is fully allocated, when every rupee of future income is already committed, any disruption creates a chain reaction. You miss one payment, a penalty is applied, interest increases, your credit utilization rises, your ability to borrow worsens. To compensate, you take another loan. The system begins feeding on itself. This is not a failure of intelligence or effort. It is the predictable outcome of a system under pressure. Now, step back and observe the mechanism clearly, as if drawn on a whiteboard. First, income enters the system. Second, fixed expenses, rent, utilities, EMIs, immediately reduce available cash. Third, variable expenses, food, transport, lifestyle, consume the remainder. Fourth, debt obligations, extract future income through interest. If there is no surplus at the end, the system has no buffer. No buffer means no resilience, and without resilience, even minor shocks trigger disproportionate consequences. This is the architecture of financial problems. But the same structure also contains the solution. Because reversing financial problems is not about dramatic change, it is about restoring balance to the pipeline. Start with the inflow. Increasing income is the most direct lever, but also the most misunderstood. It is not just about earning more. It is about increasing the ratio of income to obligation. A Rs or $10,000 increase in income has little impact if expenses rise by Rs 9,000. The system remains constrained. Next, control the outflow. Not through extreme restriction, but through clarity. Most people do not track spending, not because they are careless, but because the system obscures it. Digital payments remove the tactile awareness of money leaving. The solution is not complexity, it is visibility. When every expense is accounted for, patterns emerge. Not moral judgments, patterns, and patterns can be adjusted. Then address the core instability, debt. Not all debt is equal. Productive debt, used for education or asset creation, can generate future income. Consumptive debt, used for depreciating items, only extracts future income. The priority is not eliminating all debt immediately, but restructuring it. High interest obligations must be reduced first. This is not advice, it is mathematics. A 36% annual interest rate compounds faster than any reasonable investment return. Every rupee allocated here generates a guaranteed return, equal to the avoided interest. Finally, build the missing component, the buffer. An emergency fund is not a luxury. It is structural reinforcement. Without it, the system remains fragile. With it, shocks are absorbed instead of amplified. This entire framework mirrors larger financial systems. Consider global markets. Governments borrow, corporations leverage, investors chase returns. When liquidity is abundant, everything appears stable. But when a shock occurs, rising interest rates, a credit event, the same dynamics unfold at scale. Obligations exceed capacity. Liquidity dries up. Systems that seemed robust reveal hidden fragility. The individual financial system is simply a smaller version of this larger machine, and this is the modern thread. Today's financial landscape, with digital lending apps, buy now, pay later schemes, and algorithm-driven credit scoring has made access to money easier than ever. But ease of access does not equal stability. In fact, it often reduces the friction that once prevented overextension. Understanding personal finance today is not about memorizing rules. It is about recognizing structures. When the key variables are simple, what is your true inflow after taxes? What percentage of it is already committed? How much flexibility remains? Where are the hidden leaks? And most importantly, what happens if the inflow stops, even temporarily? These questions form an analytical checklist. They shift the focus from reacting to problems to diagnosing systems. Because financial problems are not random, they are mechanical. And what is mechanical can be understood. Return now to that moment at 2:17 a.m. The empty account, the notifications, the quiet panic. That situation is not the result of a single mistake. It is the visible outcome of an invisible structure. And once that structure is understood, it changes everything. The problem is no longer overwhelming. It becomes a system with inputs, outputs, and adjustable parameters. So the solution is not a shortcut, a hack, or a temporary fix. It is a reconstruction. Reduce the pressure on future income, increase clarity in present spending, build resilience against uncertainty. Because financial stability is not about how much you earn. It is about how your system behaves under stress. And once you see the system clearly, you stop reacting to money and start controlling it. That is the real shift. Not from poor to rich, but from fragile to stable. And in a world built on complex financial machinery. That understanding is not optional. It is survival.